Is that live?
Yeah.
All right, good morning, everybody. My name is Brad Muniz. I like to start on time, so we're going to get moving with this. If you could do me a favor, if in the questions box, we will be reviewing questions later on, but in the questions box, if you can just tell me, where you are city-wise, and that will tell me that you can hear our presentation. So if not, I have to try and work with the audio, and then you won't know what I'm saying. But if you can just do me a quick favor and send that out. Here we go. Lafayette. Hi, Denise. Okay. Seems like Denise and I are going to have our own private conversation. Here we go. See Morris County. Great. So we got some people that are hearing and paying attention. Let's go through some housekeeping items real quick. I appreciate people attending the seminar. The seminar is on revenue recognition today. Some people are attending to get CPE credit. In order to get CPE credit, you are required to submit the code words that we will give you throughout the presentation. We will give you 4 code words. I'll announce them a couple times in succession, so you know the code words. Write them down. When we send you your evaluation, just send the 4 code words written down or typed somewhere on the evaluation, and that will qualify you for CPE. We will be going to approximately 8:50 today. Try and leave some time for questions in there, and then we'll qualify for 1 hour of CPE for those that are looking for CPE. For those that are looking to hear about a topic, this topic, revenue recognition, is very significant. Today, it's being presented by myself and Adam Berger, who is an audit supervisor here at Sobel & Company. Adam also chairs the revenue recognition task force, where we've been meeting as a group to review the impact, taking client situations and seeing how it would apply to the situation, so we could talk to and counsel the clients better. I will say at the outset that this is a very, very brief introduction of the topic. Adam, how many hours have you sat through in seminars?
There was one I sat through for 16 hours, and then all the other A&A updates and that stuff, I probably sat through almost a day worth of CPE.
So you've had around 24. I probably had around at least 24, and we're still learning this as we go along. So you will see what the reason why I had Adam mention that I mentioned is that 1 hour is really a brief introduction. Adam and I are happy to extend this an additional presentation to talk on more topics, more on this topic. So if you have thoughts, questions, ideas, email them to me or to Adam, and we'll see how we can build another presentation that would be informative to people. Okay, let's get into this. Our housekeeping items. Moving on. Do you have it? Wait a second. Okay, before we get started, we do have to give the disclaimer that the views and statements expressed herein are our own and not necessarily those of Sobel & Company. We say that in case we say something stupid, which is very possible for me. Adam's a little bit smarter than me, so I have reliance on him. He's my censor. Okay, since this pronouncement came out in 2014, yes, this came out all the way back in 2014, and for private companies, it just became effective. We'll talk about that in a minute or two. You'll see that I listed some of the pronouncements that came out after that affect this pronouncement itself. So while they came out with this, they discussed it for many years, came out with it in 2014, and since then we've had 7 different pronouncements at least that affect it, and it will continue. So staying on top of this is quite cumbersome. And as I mentioned before, the effective dates for public companies, I don't think we have anybody on the call or on the presentation that is with a public business. If so, you probably adopted this already because it was effective for fiscal years beginning after December 15, 2017, which means calendar 2018 companies had to adopt it last year, public businesses that is. We deal with a lot of broker dealers as clients. We audit broker dealers, and because they file with the SEC, they are deemed to be a public business. For all other entities, it's effective for fiscal years beginning after December 15, 2018. So the problem that we will have, we being us and many of the people on the presentation, is that this is effective now. If you're a calendar year company, this is effective for you now. If you've actually done interim reporting, you should have been considering this. And if you for your end of the year reporting, this is going to be impactful. Continue on. You'll see the timeline. I just want to give it to you. The standard was issued in 2014. Between 15 and 17, you should have been preparing for this and thinking about it. In 2018, for public companies became effective. Private companies again was 2019. There are some concepts that are scoped out of 606. Adam or I will refer to the new revenue recognition as 606. Just a common phrase that people use. It falls under the accounting standard codification, section 606. The previous one was 605. And was it right?
Yeah.
Good, thank you. So if we use it interchangeably, revenue recognition or 606, you'll at least know what we mean. Some areas that are scoped out are leases, lease contracts under 840 and probably 842. That's a new pronouncement that's out. We can talk about that another day. That's extremely significant also. Insurance contracts, financial instruments, which is really, you'll see the list relates a lot to financial services companies, guarantees, non-monetary exchanges, etc. Okay, there are some key phrases that you will need to know as we go through this presentation and as you start reading more into this. So we're going to go through some of them real quick. I don't want to spend a lot of time on these because you can read them yourselves. You do have a copy of the presentation, or it will be made available to you, and you can always refer back to it. The one key of revenue that I like to say is at the very bottom. It's other activities that constitute an entity's ongoing major central operations. You have to remain cognizant that revenue, which is the top line, should really reflect your operations. So if you manufacture widgets and you happen to sell a car, one of the cars from your fixed assets, that's not part of your revenue. That would be other income. Sounds fairly obvious, but we were actually debating it recently because I think it was Adam, one of your clients, or the other clients, they reclassified some of their revenue this year, right? One of the particular industries, I think. I don't want to give up the industry as in case anybody's on, but they made a significant reclass of probably a couple $1 million, I think.
Yeah.
I don't think it's probably not significant to their total revenue, but it was just surprising because they've always classified it as revenue. Going on, a contract really comes into play when we start going through the steps. This will take you back to business law for some of the CPAs on the call. You know what a contract is: an agreement between two parties. It can either be oral or writing or implied. That's important because you know, later on, you know, as you're going through this, you may not have something in writing necessarily. I know that we deal a lot with the supermarket industry, I will say that, and a customer that walks through the store doesn't necessarily have a contract with the cashier that's written. Somebody could say them signing the credit card receipt, I guess, is the contract.
Or shipping goods or anything like that. It's whatever's customary in your business.
Right. Customers are party to the contract with the entity. And now one of the big ones, performance obligation. I have a tough time with this one. I'm going to be honest with you. I'm still under the old revenue recognition mindset with multi-deliverables. So if I slip today and Adam yells at me, as he does many times, this is the old multi-deliverables. But the new phrase that you really have to get used to is performance obligation. A performance obligation is a performance obligation contract with a customer. It's a good or service that is distinct. We're going to talk about that a lot later on. as much as time will permit. It's a series of distinct goods or services that are essentially same, are bulked together, but a performance obligation is a good or service that is distinct. And when we get to one of the steps, we're going to go into that a lot more. The transaction price is the amount of consideration we expect to be entitled. The standalone selling price is another key concept. It's the price at which an entity would sell a promised good as a separate component, and we will talk about that a lot more later on. Some new concepts, contract assets and liabilities, they're going to be on the balance sheet now more with that nomenclature as it compared to what it's been in the past. Okay, some of the other key last common phrases that we like to point out. The whole thing that I think that this pronouncement revolves around, I think you said this many times to me, Adam, every time we debate when revenue should be recognized, you always go to the essence of control. The control is key in 606. It's the ability to direct and use and obtain substantially all the remaining benefits of the asset. So who has control of the asset? And you'll see later on when we talk more about it. That's a phrase that's very important. Two other items: overtime. Entity transfers control of goods or services overtime. I know that's redundant, describing a word upon itself. And then point in time is satisfied as a particular point in time. I like to refer to make the connection of point in time is similar to the old point of sale type of concept, and overtime is what people would always remember as when you have deferred revenue or when you have a percentage of completion too. Alrighty.
I wanted to add in control when like for example, when you ship a good and the terms are FOB destination, the control isn't transferred until the goods arrive to the destination, whereas at an FOB shipping point, the goods transfer amongst once it's shipped off the docks. So
I thought I had to forget about FOB. You're bringing that back up now?
I had to.
I let that go years ago, but that's very important. Thank you for that. Okay, so let's dive into the core principles behind 606. Revenue is recognized when promised goods or services are transferred to customers. In other words, when they secure control. That's the big aspect. The other the key that we're going to focus on pretty much for most of the rest of the time today is that revenue analysis or revenue recognition has to be considered through 5 steps, and we're going to talk about those 5 steps in piece by piece. Identify the contract with the customer, identify the separate performance obligations, determine the transaction price, allocate the transaction price, and then recognize the revenue. Those are the 5 steps that you're supposed to go through, and in reality, the 5 steps that you're supposed to have documented. I want to say this, that what I anticipate as it relates to the clients that we work with, either through accounting measures or tax, or we consult, I anticipate around 10% of the clients or companies will see an accounting impact due to the change in the revenue recognition, based on the type of industries that we work with. I say around 10%. 90%, however, though, will be impacted that they have to have the disclosures changed, and 100% should have it documented. So I hope I didn't ever lose everybody when I only gave that 10%, but unfortunately that's the truth. Now, we discuss the steps 1 through 5 significantly in our office, and I will say we debate most of the time on steps 2 and 5. Those are what I think are the hardest. I don't know if you think anything else is more significant, or
no, 2 is probably the hardest by far.
So we're going to probably spend a little bit more time, give some examples there. If anybody's on the phone or on the communication and think we're talking about you directly, we're not. We're not giving up your information about your company. Okay, before we get into the next slide, I just want to give the first code, or Adam will give the first code. Please remember to write these down. So if you stepped away from your computer for a second, please come back and write down the code. What is the first word?
Performance obligation.
And he gave 2 words. So does that count as 2? But no. Okay, so the first one is performance obligation. Please write that down. And when you send in your evaluation, please send that in. And we'll give the next one in around 10 minutes. Okay, so now a definition of a contract. It sounds fairly obvious. There are some key elements that you should have and certain things to consider. Approve the contract, identify each party's rights, identify the payment terms. It has commercial substance, and there's probability that the entity will collect. It seems, and I would say on the surface, this is very straightforward. As Adam said, he and I have sat through many seminars, and one of the seminars we've sat through, the presenter brought up every esoteric scenario, including, we pretty much sold the goods, got it all out, or agreed to everything on December 31st, but the counterparty didn't sign until January 2nd. Do you have a contract? And in his position, no, we did not have a contract. So you really want to start looking, if you have agreements with clients, you want to start going through them and make sure they're documented properly. You don't want to have some auditor come in and say because of a particular situation you don't have a contract with a customer. We've deemed a PO to be a contract with a customer. Even remember, it doesn't have to necessarily be written. Could be oral and could be implied. So if there is no official contract, we deem the PO to be an acceptable contract. The last one is it's probability that the entity will collect. That is key. That comes from the old standard. You always had to be able to collect. But keep in mind, just because it's collectible doesn't mean it's necessarily revenue. Moving on, and this is where we're going to probably spend a little bit more time and give a little bit more examples. So keep watching, see if we have any questions. This is not straightforward. I think that this is probably the most subjective area I've sat through. The seminars I've sat through, and I've presented even, and when I co-presented with people, we debate things as to how many performance obligations you have. So you're required to take your agreement and your contract with your customer, and you're supposed to identify the different performance obligations. I'll give on the one scenario I always provide just to show that where it's very common is in the software industry. You buy software, there's usually a license, there may be installation, there might be training, there might be support, there may be some other things. In that instance that I just gave, you could have 3 or 4 different performance obligations. And you'll see later on why it's important to identify these different performance obligations. I work with a company that manufactures life science type of machinery, and they determine their performance obligations when they sell machinery to a customer included the sale, the installation, training, and actually shipment. For some reason, they deem shipment to be a separate performance obligation. So you've got to go through and really analyze your situation and determine and support what is a separate performance obligation. Now, Adam has chaired our group on revenue recognition considerations, and in one meeting we had 8 people in the room debating a topic, and it was pretty clear where everybody stood. The consensus is pretty straightforward. There were 8 people in the room, and 4 thought one way and 4 thought the other way. And we debated for a good half hour on the topic, and in the end, not everybody agreed on it. But it's something that you should be having a discussion with, internally and possibly outside with people.
Yeah, I mean, one of the things FASB's moving towards is more judgment-based accounting rather than factual-based, where someone asks, so where's the accounting codification that says that? Well, no, it's my own judgment now, and that's how I determine the accounting policy behind it, rather than, there's something in codification.
No, absolutely. And they're going more principles-based than rules-based. That's the way that they like to phrase it. So I'm going to give you a quick example, one where we debated over and over and over in the seminars I've been in, and I just can't get an agreement with the other, and you may disagree with me too, and it's fair. So the example that's been given in one of the by a presenter that I've seen is you go to a store and you buy a washing machine, and in that situation you have they are going to provide the installation, and you buy the washing machine and get the installation package. Do you have one or two performance obligations? Now, where do you? Now I'm going to ask Adam first because he knows what my answer is. How many do you think?
One.
You think one? Okay, I think one. I thought you thought two. Most people that I've talked to said two separate performance obligations.
It's just like, it depends on whatever day I'm thinking, honestly, because that's how judgmental it is. It's not like one day I think it's two, one day I think it's one. It just depends on whatever mood I'm in.
Right, and that's the difficulty. This is in your mind. You could be flip-flopping, but you have to come up with a concise decision, and that's got to be the position you take. You can't change it from year to year. One of my partners and I had a situation where the company changed its revenue recognition 3 times in 1 year. It's not really an acceptable practice, but it was big debates going on. In that scenario, you know, you can go back and forth. Installation, somebody said installation, why not two? That's what some people think, that there's two. I personally don't think it's two, but that I'm sorry, Nizal, if you think it's two and you can support it and you can document it, then that's fine. As long as you can get internally acceptance, and if you have an auditor, get them to accept it, that's fine. As Adam said, this is more principles based than rules based. And Nizal, the reason why I said one, not two, is I go to the last bullet, not the last bullet, the third bullet outside the box where it said, does the buyer infer the good or service is separate? Yeah, internally I may think it's two separate things, two separate revenue streams, but did the buyer anticipate it as separate? And that's where I start looking to. But this could be debated over and over. What I would recommend, and Stephen, real quick, you just said if a third party can perform. Yes, that is one of the key concepts, and we're going fairly light on this. They're not key concepts. That's one of the decision pieces. If a third party can perform the aspect, that's what people have used as a measurement to determine if it should be a separate performance obligation. What I would recommend that you do is take your scenarios, pull them all together, and talk about them internally. Talk with the service provider. You know, if you're relationship person here at Sobel & Company. Adam and I love talking about this stuff. We're happy to come out and go through this either with your contact person at Sobel & Company or you know, ourselves. Feel free to reach out, because I hate to say to just start making these decisions on your own when you may not feel comfortable and you just want somebody to bounce some stuff off of. Okay, I'll give you, while I'm at a stopping point, real quick, we'll give you the next. Is it going to be words or word, Adam?
It's just going to be one word this time.
All right, what's the one word?
Constraint.
Okay, so the next word, please write it down, is constraint. The first one, remember, is performance obligation. Well, I'm not supposed to repeat it though. And the next one is constraint. We will give the following one in around 10 more minutes. So the word was constraint, and we'll continue moving on. Good or service is not distinct / not material. Good or service that are not distinct, they're bundled together. Of course, an entity is not required to separately account for a promised good or service is immaterial. So remember that materiality still has an impact here. And you should always consider that. Materiality, I always say, is in the eye of the beholder. What may be immaterial to one person might be material to another person. So if you do have an audit relationship with somebody, I'd recommend that you talk with them about it beforehand. Don't wait till the end of the year. And then the debate comes about when the audit's going on, and you have you have potential changes based on a position that's taken. So talk about this before. I know we only have a couple months left in the year, but it's still the last quarter to have those conversations. Okay. You see step 2 that we went through. Adam and I really gave you no direct guidance at all. It was pretty much, you're doing what you think is the right way, but that's the whole concept behind principles-based versus rules-based. Is we're here to kind of tell you where you should be heading to make your decisions. Okay, so in determining the transaction price, in a lot of instances, it will be fairly straightforward. You're selling widgets, you have a contract with a customer, and you have a contract with a customer, you sell them widgets, you collect on it, done. There could be different aspects included in the transaction price, of course, a fixed consideration. If there's variable consideration, non-cash consideration, it excludes, of course, sales tax, consideration of unexercised options, credit adjustments, and considerations paid or payable to the customer. The second bullet that we have there, which we will see often, and what you really have to keep in mind, are variable consideration. Represents any portion of the transaction price that can vary upward or downward. You see some of the aspects that will affect variable consideration: discounts, rebates, refunds, concessions, penalties, royalties, performance bonus, milestones, etc. The construction industry, the reason this, let me step back 1 second. The reason this pronouncement came out was the FASB said, we're tired of all the industries having their separate revenue recognition process, and we're going to pull this all together so that there's no more confusion and everybody's treating revenue the same. I don't know how people could treat it the same, Adam, when it's principles-based and not rules-based. But anyway, we want everybody to be treating revenue the same under the same considerations. Took them years. 2014 came out, and since then they've issued more pronouncements and more guides for the different industries, particularly software and construction, and kind of puts us back to where we were with the different revenue considerations. But it still has the similar concept of the 5 steps that you're supposed to go through. As you go through and determine the transaction price, there is a constraint that has to be considered, and it's the extent that it's probable of a significant reversal or amount of revenue. It's the way that you're measuring the revenue as it relates to the total transaction price. As I said, the examples that we can give, I've actually had to pull them out of this presentation because this is only an hour long. But you if you do have variable concepts, you need to look into the aspect of the constraint. So as I said, we've gone through step 1, 2, and step 3. Step 1 is I usually consider fairly straightforward, but you can have some nuances. Adam, you did an analysis for one of the companies that we work with jointly.
Correct.
I think that their aspects of their contracts were fairly straightforward. Did you find any particular nuances?
No, I mean, I think one of the things that I found, it was a manufacturer, and they sometimes will be required to produce a certain level of goods to be shipped at any time, but they can't recognize that revenue until it's actually shipped to the customer and billed to the customer.
Okay.
But
the contracts were fairly straightforward.
Yeah, a lot of it had like the legal jargon, like with warranties and stuff like that. I think one of the big things, going back to step 2, is if you have like a service type warranty. So if you're going to go in after the fact and maintain something that was installed, that would almost be considered a separate obligation. Whereas if you have like an assurance type warranty for like quality assurance, for example, if an item breaks down or something like that, and you'll be responsible for replacing it, that's not considered performance obligation.
All right. Yeah, the warranty,
Yeah.
that falls under the old warranty standards.
Yeah.
Thank you for saying that. You can sell a warranty package.
Yeah,
That'll fall under revenue
Recognition.
recognition. But when your warranty or, the guarantee or, we promise to replace everything, that falls under the warranty standards. That's completely separate. So we've gone through step one, which in most cases I think is going to be fairly straightforward, but you should discuss this internally and with some other people to make sure that you do have that confidence level. Step two, I think, is where you are going to be spending a lot of your time to determine how many different performance obligations. And by the way, you can have different scenarios where in one type of sale you have multiple performance obligations, in another type of sale you will only have one performance obligation. And we're going to get to that also later on when we get to step 5. Step 3, again, is just determining the transaction price, and that is the transaction price in totality for all of the performance obligations, and if there's any other variable consideration. And that brings us then to step 4. And now you have the contract, you determine your performance obligations, and you've determined the contract price. Now you have to allocate the transaction price over the performance obligations. Okay. I hope you're happy. I haven't said multi-deliverables once yet. So what you're obligated to do, you have your transaction price, as I said, in step 3. You were to allocate that over the different performance obligations that were identified in step 2. It sounds fairly straightforward, but it all depends on your system that you currently have and you anticipate to use. I've seen the scenario many times. I'll give you 2 different type of billing systems or contracts, agreements with customers, not billing, agreements with customers, where you say, we're going to provide you these different 4 performance obligations: software license, installation, training, support, and it's going to be $10,000 in total. Or you can say, we're going to provide you those 4, and the license is $5,000, the training is $1,000, I have to come up with 10,000, right?
Yeah.
So I'm at 6 so far. The installation is 2, and the subsequent support's another 2. Okay, that's 10?
Yes.
Okay, good. I did the calculator.
Yeah, we should be good at math as accountants, but we're never good at math.
And you've broken it out separately, which is fine. You can have either one. You don't have to change your agreement practices with your customers. You don't have to necessarily change your billing practices, whatever works for you. And you can have it different for different customers too. But what you're obligated to do now is allocate the transaction price from step 3 over the different performance obligations identified in step 2. And in many cases, we'll go to the second example I gave before. It should be straightforward, where I've broken it out between the different performance obligations, and that's my transaction price. Now, subsequent discounts could affect that, and we can talk about that another day. You have to determine also, the one nuance I'll give is, if you do that, is it consistent to all the different customers? And they may not be consistent, and that's okay. But it's difficult to set a trend of pricing by performance obligation if it's different for all different customers. Where it starts to get a little bit more difficult of a concept is when you have the first scenario that I gave, where you have a contract with a customer to provide the 4 different performance obligations, and you have one price. And what you're required to do is allocate that one price over the different performance obligations. And it could be done based on market or based on historical practices. But you have to be able to support that. And I'll say, as an auditor, these are the areas that we're going to have to focus on, especially this year in for the 2019 audits, and even the reviews as part of our discussions. this is one of the areas we're going to have to significantly focus on, because it's an estimate, it's management's judgment, and the AICPA is telling us these are two areas that we really need to be focusing on and documenting. So when the auditors come out and they ask a lot of annoying questions, please don't be offended by it, but this is an area that we have to really focus on and make sure that it's documented, and the considerations is documented and really supported. But in that scenario where if you had two different customers and you sold each of them the same products for $10,000, and you historically break it out, the 5-1-2-2, as I had mentioned before, and then you have some where it's just the $10,000, I would use the other client, the other customers' transactions or historical practice as support of our pricing mechanism. I did have a scenario of a startup software company where the trends were just extremely difficult to get our arms around. This goes back to 2005, so this is a real long time ago. But they would sell pretty much the software at whatever they could get. If they sold it for $2,000 to one customer and support for $1,000, they may sell software to the next customer for $500 and get the support for the $1,000. They were trying to get whatever they could, but when they sold the next contract for combined of $1,500 or $1,700, let's say, I had a difficulty trying to allocate it accordingly. And now I know that scenario, somebody sitting there real quick with the math and saying, well, Brad, you used $1,000 for support twice. That would be the market or their internal history. Yes, but there were a lot of fluctuations. Were you gonna say something?
Yeah, I was gonna add, if, for example, you're going back to your software example, if you're selling $10,000 worth of software installation, training, and maintenance, and you're allocating a lot of the portion to the installation, is that going to be a red flag for an auditor? So like you use $6,000 for the software, what if they switched software and installation?
Sure.
Because when we get to step 5, I know I'm skipping ahead.
You like to skip ahead.
Yeah.
You ruin all the surprises, huh?
Installation would be once you install it, you can recognize the revenue, whereas the software, you would recognize it over time. So someone might say, oh, well, the installation, I'm going to recognize 6,000 right then and there, but even though the software is your key product.
Yep. Yeah. If standalone selling price is not directly observable, you can adjust at market, expected cost margin approach, residual approach. If there's variable consideration can be allocated to one performance obligation only if both of the following apply. The terms related specifically in satisfying one performance obligation and subsequent changes in the transaction price. One of our partners and I were working on a litigation matter, and it related to revenue recognition, the litigation matter, and it came, what I identified in one of the contracts was they allocated with no supporting measure, a variance, a discount to only one aspect of a performance obligation, and they allocated to the one that was being spread over time rather than the one that was at point in time, to be able to recognize more up front. Before we go to the next slide, I want to give Adam wants to give the next code word. So please remember to write this down.
This one is multiple words again.
Oh, brother.
It's standalone selling price.
That's 3. You went from 2, 1, 3. Standalone. It's 4 actually. Standalone selling price. Standalone selling price. Yeah, 4.
You'll notice a trend as we go through the steps. You know, we're getting one word out of the way. You know, just so you remember the key phrases from each step.
I asked you for 4 words. I did say accounting to keep them from being dirty, but I did put the disclaimer there, so you could have gotten a little crazier, like Gilligan's Island or something. I don't know. But all right. So you've gotten your three code words so far. We've gone through steps 1 through 4. I like to repeat myself, so I apologize if it annoys you at this point. 1 is the contract, 2 is the performance obligations, 3 is the transaction price, 4 is allocating the transaction price, and you've got it all calculated at this point. Now you have to determine when you're going to recognize the revenue for the different performance obligations. And there are 2 methods pretty much that you can recognize revenue, or how you recognize revenue. As I said before, step 2, I feel step 2 is the hardest to come to an agreement on. Step 5, I think, is the next hardest. And in the end, it might be a very simple concept, may not affect you, but this is where I think I've seen in our office in particular, debates tend to come up. The first one is you're either recognizing revenue over time, and in order to recognize revenue over time, the customer simultaneously receives and consumes a benefit. The entity's performance creates and enhances an asset that the customer controls, and the entity's performance does not create an asset with an alternative use to the entity, and the entity has an enforceable right for payment. Okay, so the overtime is similar, not exact, but similar to the percentage of completion. You recognize the revenue as the project goes on, but in order to be able to do that, the customer, in the end, is one of the pieces, has to get benefit of an asset and obtain control. That is key here. If you don't match those, this is what I love about accounting. If they say if it's not this, then it's going to be this. So rather than describe what point in time is, they just say if it's not overtime, then it has to be point in time. And remember I said earlier, point in time is very similar to point of sale. And supermarkets, they don't recognize revenue over time. You walk through the store, they're not saying, although my mother actually used to walk through the store and eat grapes and eat some of the stuff, so I guess they could have been recognizing revenue for her.
Or when you're in Costco and you're going for the samples.
There we go. Wow, we just came up with a big problem. Yeah. Okay, but that's immaterial though. Yeah. Okay, let's agree with that. As you go through the store, they're not recognizing revenue because you're not consuming the benefits and you're not taking control of the asset until you get to that register, pay, assuming there's collectability, and you walk out the door and there's your point in time sale. Okay, you have to determine for you and your customers which criteria you fall under. Revenues are measured over time or recognize that entity as a progress towards completion, control, and appropriate methods of measuring progress include output methods and input methods. I'm just watching the time. We've got like 5 more minutes to go. We got a few more slides. So if you're trying to determine the way to measure your overtime revenue, there are 2 components two methods that you can use in determining which way to value the revenue that you're recognizing. The first one is output method. Those are direct message of the value to the customer. Okay. The other one is input method, and it's the entity's efforts of inputs in satisfying the performance obligation. For example, costs incurred relative to the total expected inputs. If you read that sentence, again, I'm trying to look to see who's part of the presentation. If you read that sentence again, what does it sound like to you? To me, it sounds exactly like the old percentage of completion, expected total cost for the contract to create the product, and the amount that we've incurred to date. So they can't go with the old nomenclature. They've got to create the new words of the input method. And that's what I anticipate. We're going to see a lot of customers that are recognizing overtime, that they will be using the input rather than the output method, because they may not be able to determine the value as deemed by the customer. Okay. Continuing on. Point in time versus overtime. You should also consider the following: the present right of payment. Entity has a present right to payment of the asset. The customer has legal title. It has transferred physical possession, significant risks and rewards of ownership of the asset, and the company has accepted the asset. So let's say you're constructing, and I keep going to contractor, so I apologize, but it's an easy one to do. If you're constructing a building and they're able to, and part of your process, your construction project is design and, is there a question or no?
I don't want to interrupt you.
Oh, okay,
but
I'll just finish this real quick.
Okay. Yeah.
It's design or, and you do the bathrooms, the kitchen, the basement, and you do the basement first, and people can access the basement and they live in it as you're working on the bathroom and the kitchen upstairs. Then you do have a situation where you have a right to payment. They've taken control of a portion of the asset, et cetera. So these are the things that you have to measure. Was there a question, Adam?
Yeah, Mahesh M. I just don't want to say your name because I'm afraid I'm going to butcher. The webinar is going good. Will an archive copy be available for me to share with my team? Yes. I think right after this presentation, an email will go out with the copy of the slides and as well as the CPE form.
Thank you for that. Also, I believe they're trying to record this and put it out as a podcast. So you can always email us back, and we'll try and get you information if they do have the recording available that becomes edited, that we'll make available to people. But you do have a copy of the presentation, and again, if people feel that they need to hear this again or go deeper into a topic, email us and we'll determine how we can do this, because this is not an easy concept and we really are rushing through this because we just wanted to hit on some of the key points. Oops, sorry. Watching the time here. Right to return. A return is not a separate performance obligation. You have to estimate your returns. Okay. Your revenue has to be your revenue is only recognized to the extent that is not expected to be returned. This is not something new. Revenue should expected return should be calculated in the same way as other variable consideration. You know, the big stores, you know, the Macy's, the I don't want to say, I was about to say Bambergers, but you're going to look at me like you not burgers, Bambergers. Gimbals, you know, these stores, all retailers are supposed to estimate the anticipated returns in the following year. It makes it difficult when you have the stores that you can go back years later and bring back merchandise, but they're supposed to estimate their returns. They've been doing this for years. I've been working with companies on estimating returns. You're required to create some sort of reserve or recognize your revenue accordingly. One of the other concepts that's not necessarily directly relates to this, I like to mention because it does come up occasionally: gross versus net. Do you recognize revenue gross or net? Meaning, if I'm a distributor and I'm selling a product, do I recognize the gross amount or just my commission? It all depends on what entity takes control. A principal entity takes control of the goods or services which it sells. This decision, the process of deciding which way really circles around control and risk. Who's taking the risk? If you're a real estate agent and you're selling a house, you don't have the risk unless your contract says, if I don't sell this house, I have to buy it from you. Most of them are, I will try and sell the house and I will get a commission. Accordingly, a real estate agent should only be recognizing the sale of the commission as revenue. Whereas if you're a broker and you are taking responsibility for the inventory, and you may not take possession, but you're having it transfer from one place to another, and you have some sort of responsibility, you would be recognizing not just the commission, but the sale of the product also. But you should go through that analysis, and in the office, I get into this discussion in these debates regularly. And let's just hit a couple more slides. I see it's coming near the end, and we have one more keyword phrase, and that is
The output method.
output method. Okay, back to 2. We gotta, you and I have to have a discussion for the next
Yeah.
presentation on one word. So the last code word was output method, okay? The couple more concepts, contract costs. If you have costs relating to a contract, they can be capitalized. Now, let's be honest, in most cases, what you'll see here, there's a phrase, practically expedient. In most instances, it's just going to be more practically expedient to expense the costs. I'm not even going to get into tax. That's not my topic. But in most instances, it's going to be practically expedient to expense it. But you can capitalize the contract costs. In order to capitalize the contract costs, there are certain criteria that you have to meet. You have to meet all these 3 criteria. The costs have to be directly related to the contract. They have to generally enhance the resources of an entity, and the costs are expected to be recovered. Okay, and if you do have significant costs, you do have to recognize, you have to consider them for impairment. Now, most instances, the costs are not going to be significant, but if they are, you might want to consider capitalizing them. The last area that we're going to just even touch on very, very briefly, because this is one that's going to impact 90% of the companies, is a disclosure. The disclosures have changed significantly for as it relates to revenue recognition, and you'll see on these 2 slides just some of the information that has to be disclosed. The public companies have been working with this for the past year, and what we always do, and we recommend to companies to do, is go get a public company's financial and look at this disclosure, and you can learn, or determine, what disclosures to make. Only problem is, in this pronouncement, the public company disclosure is much more significant than private companies, which is good. The issue is, if you go and copy their disclosures, you're going to be spending a lot of time for where you may not need it. And there's some guidance out there and some examples out there, but this is going to take a while to cultivate, and I anticipate you're going to make some disclosures this year, which next year there'll be changes, and the following year there'll be changes. But I recommend that you at least try and get the big items and the really significant items and have them disclosed properly, if not everything. One of the first ones, I'm not going to go through every bullet, but I just wanted to mention a couple. You have to disaggregate your revenue and your disclosures between those that are treated as overtime and those that is point in time. So you could be a company that has certain performance obligations where you're recognizing overtime, and some that you're recognizing as a point in time. And within your disclosures, you don't have to do it on the face of the income statement, but in your disclosures, you have to disaggregate what revenue is recognized overtime and what revenue recognized as point in time, and that has to agree to the financial statement too. Contract balances, information about performance obligations, in other words, describing your performance obligations, remaining performance obligations, significant judgments, contract assets, liabilities. If you determine things to be practically expedient, and as it relates to the performance obligations, what you should disclose is when the company typically satisfies them, significant payment terms, natures of goods and services, rights of refund, and what warranty obligations you have, not the warranty support that you're providing, or not. We'll call it support versus warranty. Warranties where you promise to replace or repair something. What obligation you have. So you'll see that Adam and I really sped through this, and it's only because we wanted to give you the overall breadth of the 606 guidance that's out there. You have to go through a 5-step process in determining your revenue recognition, and you have a lot of disclosures. I guess what I just said there in the matter of 15 seconds, we could have said in the beginning, said the 4 code words and been done, huh?
Yeah, right.
Right, but I like to talk. So, yeah, don't agree on that.
You like to hear yourself.
I like to hear myself talk. Thanks, Adam. So this is Adam's last presentation, I guess.
Yeah.
No, I want to thank everybody for attending. I have been watching to see if there are questions. We had very limited questions. I saw Liz said something about contract and it was capitalized. I don't know what she was saying.
Something about how the contract is written.
I don't know what she's saying. Do you know what
Yeah,
she said?
No, I
I'm just looking at the questions, and that's the only reason why I'm not wasting time trying to make sure we answer people's questions. There really weren't many. The webinar will be available. The third party can perform, Stephen, yes. As I said before, we are going to wrap up right now, but if you have if you want to talk about this further, if you want to hear more into the topic, let us know. And if you want to have somebody come out and talk with you about this, solar companies more than happy to do that. And you know, just to get the process going. So I encourage you. It's now September 12th. You have just over 3 months. Focus on this, because when the auditors come out, and even the people performing a review, we're going to be questioning about this and what your considerations are. And at a minimum, we have disclosures that you're going to have to do. It'd probably be best if we start working with you on those disclosures now. Because otherwise, when the financial statements are needed by a bank or somebody else, we don't want to be holding it up because we're coming up with revenue disclosure. So with that said, I think we went just a couple minutes over, more than a couple. I'll thank you for your time, and we got to get Andrew in here. Andrew, you can close it down. So, we'll send out the evaluation, send us back to the code words, and we'll give you your certificate. Thank you, everybody.
yeah, thank you for listening.
We're done. Goodbye. Shut it down. On air, it says. Did Andrew fall asleep? We're still on air. Don't say anything bad. Yep, door's open.